Let's go, folks. Good morning. Welcome to the Street's opening bell here from Post 35 on the floor of the New York Stock Exchange. I know what you're thinking. Is that green screened? It's not. That's where I really am. It's Thursday, the 29th of December, the final show of the year. It's very sad. I'm your host, JD Durkin. Opening bell rung moments ago here on the floor by Gradient Investments and Innovator Capital Management. Excuse me. Taking a look at how the major averages are kicking off this Thursday. Stocks are actually up right now, fractionally, but that's where they are, as investors look to close out what has been a pretty brutal year on Wall Street. A down week, a down month, a down year. Stocks are coming off yet another down day as hopes of the year-end rally seem to fizzle. Where are you, Santa Claus? Asks every investor. Taking a look at what is on tap for this morning's show, we will talk what to expect in the new year as investors look to close out the final trading days of 2022. Plus, we will be breaking down what is going on with Apple as that stock falls to a 52-week low. And finally, we will tell you what stocks to consider or reconsider heading into the new year. Maybe we'll sing a little Auld Lang Syne. I won't. Maybe Chris will. For more on those stories and so much more, we now welcome our Action Alerts Plus co-portfolio manager and maybe part-time singer on the side. I don't know. Chris Versace, you're a man of many talents and many surprises. If you'd like to bust out a little rendition of something at the end of the show, you're welcome to do so. I do want to get your sense here on what we're seeing with the averages these last few days, closing down in the red again yesterday. What are some of the biggest factors weighing in on these markets, my man?
So I will tease this, JD. By the end of the program, you will learn perhaps a skill that I do have outside of looking at the markets and running the AAP portfolio. So a little tease for people to hang into the very end. But in terms of the market, you know, we've had this conversation pretty much over the last several days. And, you know, we do have a quiet week, not a lot of news. Trading volumes have continued to thin out. Typically, this happens between Christmas and New Year's. So all of that is kind of tracking. I think you hit one of the nails on the head yesterday when you talked about tax loss selling, people kind of getting ready for 2023. But I think as we look forward to 2023, the growing question is, and again, it's a little repetitive, but this is the theme, the narrative of the week. Is there going to be a recession? How deep will it be? How long will it be? What does this mean for earnings? And am I building my shopping list for when that happens come mid-January as the December quarter earnings season kind of kicks off? The other thing that's really weighing on markets, again, we touched on it earlier in the week, is the thought that this might be the end wave of COVID cases that we're seeing in China. Is it not? So, you know, a lot of uncertainty as we round out a year that was filled with uncertainty. I think that means that when everybody's back from the year-end vacation season, there's going to be a hard look at some expectations as we get a lot of data next week. We also see CES 2023 kickoff. So a lot hitting the ground as we kick off 2023.
I forgot about CES. That's out in Vegas, right? And that's right around the corner.
It's January 5th through the 8th. And I think it's going to be pretty topical this year. You know, leading up to the end of the year, the last few months, what have we heard? A lot of excess inventories, PCs, other devices, questions on production, given what's going on in China. But typically CES is one of those times that companies come out, they make some bold announcements for products hitting later in the year, usually in time for the holiday Christmas season. Sometimes we get some kind of concept, you know, products announced as well. I actually think it's going to be a pretty interesting time because I think in addition to all of that, you know, it kind of comes before the December quarter earnings season, after companies close their books for the December quarter. I think people are going to be leaning a little more into, hey, what's the tone of the environment? What's the market really looking like? Are things that bad? Is there more downside risk ahead? Prepping themselves for that December quarter earnings season.
I do want to ask you about a rare piece of economic data we got in this otherwise shortened holiday week, and that is weekly jobless claims. The figure, if I'm not mistaken, 225,000, right in line with expectations. So we do have an environment right now where more Americans are seeking unemployment benefits for the first time. But is it happening at the rate, at the pace that the central bank wants to see? Different question.
You know, yeah, it's an interesting question, and I don't think so. I mean, it's nudged up a little bit. I think the continuing number is around 1.7 million, something like that. Not really a huge shift in the last couple of weeks. I think the far more telling data will be had next week. We get the November JOLTS report, so job openings. That will be kind of key to see if companies are kind of reining in. Yesterday, we talked about some investment banks, cutting bonuses, and my comment was, I think we're going to see, some job letting happen, as we enter 2023. We heard that from Goldman this morning, being widely reported that they're going to announce some job cuts in the next few weeks. So that JOLTS report is going to be key. I also think towards the end of next week, we get the December employment report. Again, how many jobs were created during the month, but also it's going to allow us to revisit one of the things that Fed Chair Powell talked about. That's, of course, wage inflation. So I think, yes, it's a economic data point that we had this week. Fine, okay. I wouldn't read so much into it given what we have ahead of us.
The holidays are volatile for jobless claims because we could see so many revisions week to week, right? Let's say I'm just making this up, but if you're a Walmart and you have to, for whatever reason, have cost-cutting measures, you may sit there a few weeks later in December and say, oh, oops, actually, we need to kind of revise those numbers and look to kind of scramble and hire people back that we thought we didn't need. Why is this labor market overall remaining so hot right now, despite the best efforts of Chairman Powell and his colleagues?
It's one of the things I think a lot of folks are kind of, struggling with to figure out. I know that when I go places, I was at Costco last night, service was great. But when I go to other restaurants and things like that, there continues to be this shortage of workers. Is it that, the wage demands are too high? Is it that people don't want to do those types of jobs? It's a big question. And I think some of it comes down to the number of folks that took early retirement, people that have simply left the labor force altogether, folks that have gone back to school, as a result of the pandemic and subsequent quarters after that. It really makes for a challenging labor environment. And when I talk to local businesses, some of them say, I can't find anybody. Others are like, hey, the people that we do find, not only do they not have the skills that we need, but what they want in terms of a total package, salary, benefits, all this stuff is way more than we can afford. And it's interesting that you asked that question because one of the things I've been reading about is a growing trend, I guess is the right word, among fast food restaurants incorporating robots and other forms of productivity, including ordering. I walk every so often, not that often, into say a McDonald's or something like that, and it's kiosk ordering now, and there's one or two people actually running the location. So I think it's going to be kind of tricky. The other point I would make is I think one of the things that you mentioned was seasonal hiring. And the data from MasterCard that we got early in the week said that holiday sales were a little stronger than expected, more online, kind of not as robust in store. So there could be something to it that companies ranging from Target, Walmart, and all the others that were staffing up for expectations for a brisk in-store holiday shopping season might have started to let people go sooner than expected.
Did you say you were at Costco? And if I heard that correctly, did you have anything to eat?
I did. I tweeted it out last night. I was doing my due diligence in Costco. And if you're next question is, did I get the hot dog and soda? You bet I did.
$1.50? How much is it?
$1.50 with 14 cents tax. $1.64.
With 14-cent, that part gets left out of the headlines. What tax are you paying on the infamous $1.50? See, that's why we ask the important questions here on the show, to really dig down into the numbers so people know what all this information means for them. At this point, of course, we had this time last week, it was all, where are you, Santa Claus? Are you coming back to town? Maybe we're not really going to get the end of the year pop, but after today, we're still looking, binoculars on. After today, we still have tomorrow, 2 days of next week for the so-called Santa Claus window. Any reason we may kind of have a jump? Keeping in mind here, the S&P is up 1.1%. We're at 38.25 right now. So I guess maybe it's a wait and see thing.
Yeah, I mean, we've got to see what the overall move is over those 7 trading days. I think tomorrow is going to be a kind of a very quiet day. We tend to see as we approach these long holiday weekends, the volume, tends to drop off in the afternoon. I think that's going to happen again. But when we hit the ground running on Tuesday, here we go, data. We're going to get the S&P Global PMI data for December. Wednesday, the last day of the rally, we get that JOLTS report. We get the ADP employment change report for December. And we'll get ISM's manufacturing PMI report. So I really think that the make or break for the Santa Claus rally this year is going to go right down to the wire.
Just real quick, ISM Manufacturing early in the week. There was one before that. I just want to make sure we are stressing what people can expect if they're going to close their
Yes.
laptops for the next few days. What are we walking into Tuesday?
Yeah. So there are three big things. Actually, we can talk about four, right? So on Monday, even though markets are closed, S&P Global is going to report the December PMI for the Eurozone. That'll be kind of interesting considering they've been in contraction mode and seeing continued inflation pressures. But the three on Wednesday will be ISM Manufacturing PMI, ADP Employment Change Report, the precursor to Friday's employment report, and then what did I say? Oh yeah, the November JOLTS report.
That's right. Okay, labor turnover and job openings, and then of course, yeah. Thank you for the reminder. First Friday of every month. Of course, 8:30 a.m. Bureau of Labor Statistics. We get that key number, so we get the ADP as a precursor to what that could be. While it is a historically quiet time for the markets, investors have been paying very close attention to a whole lot of economic data. I wonder, after this next week, are there top data points you think more broadly for the month of January that you'll be tracking? If we were to kind of take like a little bit of a mid-range view here, Chris, what does the month of January hold? Because as many people say, as January goes, so goes the year. And do you subscribe to that theory?
I try not to, how do I say this? Yes, I understand that that's a kind of a convention, but I find that if you rely too much on those, you can get trapped and kind of miss things. So what we try to do is always listen to the data, evolve. Here comes one of your favorite words, our investment mosaic, our investment tapestry, as we get more data. So of course, as we move past next week, the data will continue to flow, but that's also when we're going to start to get the December quarter earnings season starting. The big thing that I'll be watching in between, when we return next Tuesday and the official kickoff of the December quarter earnings season is going to be pre-announcements, both good and bad. And I think those will set the tone for the December quarter earnings season.
All 11 sectors of the S&P are down for both the week and the month. Are there any sectors you view as a potentially better play as we look ahead to the new year?
So I'm going to share a very unpopular thought here, which is I actually think sector investing is dead. I say that because it's very hard, in my opinion, to shoehorn 500 or 1,000 companies, depending on the index you want to use, into 11 little categories. Not only that, we tend to see companies continuing to morph, change their business models over time, evolve. So, putting them in those little buckets, I think, is kind of a waste of time. I think if you, I like to think about the market, not saying I'm perfect, not saying I have all the answers, but when you really try to figure out what's pushing on a company's business, looking at the changing landscapes of, economics, demographics, technology, regulatory mandates, and the like, as I like to say, take a thematic approach to things, and we've shared this view with AAP members. I think you can identify which companies are better positioned to prosper and ride the waves of those changing environments. It also allows you to capture more pure play companies tied to that. And when you have that, you kind of have an A plus B equals C. The A plus B is, companies that are riding the thematic waves, right? The structural changes that are unfolding, driving on their revenue, driving on their cash flow, driving on their EPS. That typically gives to B multiple expansion. And we put those two together, we get C, alpha generation. So I think that's a much, much better way to look at it rather than saying, oh, do you like technology? Okay, well, what aspect of technology do you want me to like, right? Do you want me to like chips, PCs, data centers, displays? I mean, there's, wireless, wireline, cable. It's such a kit and caboodle that I just shun the whole thing altogether.
I do want to ask you about tech. Big tech stocks collectively have lost about $4 trillion in value in this calendar year. And one of the top topics of conversation is, of course, Apple. That stock hitting a 52-week low, concerns over its holiday production mount. We talk a lot about the Tesla China story, but for some reason we've kind of put on the back burner the Apple China story a little bit. And now I think suddenly in the last 48 hours, I see Apple in focus nearly everywhere. What is the latest with the company, and what stands out to you as important for investors to keep in mind, Chris?
Well, the biggest concern is, and you hit the nail on the head, we talked about it, or alluded to it earlier, this N wave that's going on in China. Is Apple going to be able to produce enough iPhones for the holiday shopping season, right, which extends through the end of the month and into January to meet demand. And all indications are that it probably won't. And Apple came out several weeks ago, and even though it didn't give formal guidance for the current quarter, it did share its expectations it revised its expectations, saying things were going to be lower than it previously thought. In the last couple of days, as we've seen this surge in COVID cases in China, we've seen other investment banks start to cut their expectations again for iPhone shipments in the current quarter, again, largely due to production. There is data that says that Apple is winning share in China amid a declining smartphone market overall. That's a positive. And I think that as those production levels come back to more normalized levels, then I think we'll have a much better sense of what 2023 is likely to be for Apple. The other wild card is we've heard a lot more chatter in the last few months about its augmented reality headset. Rumor has it, the company could make an introduction sometime. Could be first quarter, could be first half of the year. That's potentially another growth engine for the company. And before you ask, do I think they will do this at CES next week? And the answer is no. Apple never goes to CES.
Yeah, they like to have because they dominate when they do those Apple days. It's all eyes of the business world, specifically on Cupertino. The presentation, admittedly, is, it's polished. It's the production value is incredible. Why not just dominate your own space, make your own mini one-day CES, as opposed to going into this whole other thing.
The funny thing about that is they almost have their cake and eat it too, right? Because they do have their own event. But even during CES, there's so much chatter about what Apple's saying, what Apple might do, Apple. At times, it really overshadows the event. And the funny thing is, they're not formally there giving any presentations.
That's a major flex. That's what we call that. That's how you know you're the big dog in the space and
Right.
viewed by many as maybe the most important company. It's interesting here. So Apple stock is down 29% year to date. Sounds terrible. You compare it to some of its rivals because they're not direct comparisons. Amazon is down 51% year to date. Alphabet Class A shares are down 39%. Apple's still having a bit of an update today at 2.5%. A lot of people are going to be asking, okay, Chris Versace, then where's my buying opportunity? When is my buying opportunity? Do you see that happening in the first? Are you expecting higher volume interest in the stock in the first few months of the new year, especially given all the headlines we're seeing now?
So, we shared with AAP members earlier this week that we were likely to see, quote, bargain hunters come out, taking advantage of what we've seen. The market is oversold, and it's understandable that some people might be very interested in some of these names, buying them up at, quote, cheap prices. But, like we talked yesterday, JD, there's a lot of questions over what the E is going to be, as in earnings, and what that means for PEs, the market valuation. So my concern here is that we could see a potential head fake during a low volume week. And I would caution people to kind of sit on the sidelines a few days. Let's get into the first 2.5 weeks of January. We'll have a much better sense as to what expectations for the earnings are for the S&P 500. We'll get a lot more data as we talked about, giving us a sense as what the manufacturing services outlook is, what that historical correlation means for S&P 500 revenues, and a whole host of other things. So I would not be jumping at the bit just yet on some of those names.
Yeah, it's interesting. There's a lot of hope for what Apple could do specifically in the wearables space. A few just out of reach components, right? If you could really build an effective wearable that does a better job of tracking things like your active blood pressure. You know what I mean? There are these things that Apple, we get a sense, is kind of working towards that could kind of now push it into a whole new territory in terms of creating the technology and making it more accessible for health-related goals that right now we just don't have on the market. And that could be obviously a massive tailwind if Apple is able to figure out those pieces. Far easier for me to sit here at my desk and say than the brilliant engineers to figure out, but still.
They are a company that has a long-term roadmap, no question about it. Tim Cook has come out and said that the area that Apple could potentially leave its biggest mark on is indeed healthcare. And as I just sit back and kind of, revisit what I said a few minutes ago about thematics, one of our themes is aging of the population. When we look at that demographic trend, clearly there's going to be a large opportunity for Apple to tap into that, as well as other companies as well.
All right, let me ask you about Lockheed Martin, that company awarded with a massive contract to expand weaponry and defense systems. Chris, why is this company one to watch as we head into the new year?
Well, we've liked Lockheed Martin at Action Alerts Plus portfolio. We're long the shares. We currently have it rated a 2. We like what the company does. And if we take a look at the environment that we're in with the Ukraine war, potential strife in, China with Taiwan, there's a lot of reasons to think that military spending is going to continue to be robust. You and I spoke about this, I think, recently, and the bill authorization came in as expected, larger than was requested by the White House and up nicely year over year. And the more contracts that we see won by Lockheed Martin, they tend to be multi-year contracts. It gives us a lot more visibility. These are not typically 3-6 month contracts. Again, they're multi-year, and the one that they won that was announced early this morning, late last night, spans all the way out to 2027. So really good visibility at a time when people are when people are concerned about the first half of the year, the first 9 months of the year, potential recession, earnings coming down. This gives a lot of staying power to the Lockheed Martin business model.
In your morning note, Chris, you highlight the importance of looking at EV stocks with those EV tax credits set to roll out in 2023. What are some companies that investors should be watching and more closely following in this space?
Well, let's set the stage for that, right? So, we talked about this a little bit yesterday when we were saying that, holy cow, man, these EV stocks have been battered. It doesn't matter if it's Tesla. We can take a look at NIO, XPeng, and any of the Chinese EV companies, Rivian as well. We can take a look at all of the EV charging companies, just obliterated really since their highs in mid-September. But you are correct. We have a catalyst that starts to kick in next week. That is the tax credit that goes for not only passenger cars, but light trucks, heavier trucks as well. And I think the misconception here is that people tend to be solely focused on passenger cars, right? Your Teslas, your Fords, and we do own Ford in the AAP portfolio, but Volkswagen, Chrysler, Fiat, and the like. But we have to remember, too, that the overall push towards EVs is far larger than that. Everything from light-duty trucks, heavy-duty trucks. I think PepsiCo is taking EV trucks now from Tesla and others, but also vans, especially delivery vans, UPS, FedEx, Amazon. So this tax credit is really important to watch. It not only makes passenger EVs more affordable to the average, average consumer, but it can also be applied to some of these other vehicles as well. And I think what we're going to see emerge is a continued push-pull in the EV space. We're going to see more people move into EVs. All studies, all polling data seems to suggest that. It's going to continue to create what I call a pain point for EV charging demand, right? I've got an EV, I got to charge it. I need some place to charge it. That is why the Biden administration included the EV charging build out for its Biden infrastructure law. And I think this is going to be another multi-year opportunity for investors, especially since these stocks have been battered in the last 3 months, arguably extremely oversold. That spells an opportunity, particularly for those people that are longer-term investors. Please be patient. Let the story play out.
It's also interesting to me you call it the Biden infrastructure law.
That's what it's
called. In terms of
called.
branding, is that yes. Not everyone refers to it specifically with the name of the president attached to it, but I do. It's interesting. I pay attention to political messaging and I watch how things are phrased and framed. I'm not arguing with the description, but of course when you have, it's just it's no.
I will say this. There's no political agenda there. I just call it that because that is its proper name.
There you go. Fair enough. Okay, so we talk a lot about tech layoffs, and those headlines from, obviously, Twitter is its whole own disaster, but just in terms of an operational challenge, clearly, whether it's Amazon or any of these other companies that have had a lot of layoffs. We haven't necessarily seen the headlines branch over into a lot of other spaces, but Goldman Sachs CEO revealed that job cuts could be unveiled at that bank in the next few weeks. And give me your sense on what Wall Street layoffs look like and whether or not you think that space is kind of just getting started.
Yeah, I do think it's getting started. We've heard some rumblings about layoffs already from Wall Street investment banks. And again, no real surprise. It goes hand in hand with the weak bonuses that we talked about yesterday, right? You look at the tone of the IPO market, the M&A market, and some of the others. They are going to do some right sizing. So, we talked a little bit about this yesterday. I do expect to see more of that happen. I wouldn't be surprised, too, that alongside those announcements, we see other sectors, even though I don't like that word, or other industries start to do the same thing and right size as signs of a recession perhaps become more likely.
We've seen a flurry of layoffs. Of course, you expect the job cuts to ramp up in 2023. I mean, I guess that's kind of part of what the Fed wants, right? You want to see an uptick in unemployment. It sounds counterintuitive to people looking at it from the outside, but give me your sense. I mean, what is the latest number? How high are we expecting unemployment to go? Or if you had to bet, where do you think unemployment goes at some point in the year? That might be an impossible question.
Yeah, it's kind of a tough one, but I do think, just from a sentiment perspective, I think you're right. I think the Fed would like to see the unemployment rate climb higher. That would take some of the wage pressure off and really lead to a less tight, not sure if that's a good description, but a less tight employment market. As far as where it could go, could it go to
We may have just lost Chris. I think we just did. We just lost Chris's shot. We're going to work
looking
to get
for around
Chris's
that level?
Chris, I lost you for a second. You got me?
I can hear you, but I cannot see you, JD.
I got you, my man. There we go. See, I was worried the last show of the year. I said, I don't want to end early. I want to make sure that we got you. We did lose the last sentence or so, so I want to give you the opportunity to finish that up before we go to rapid fire.
We both know you want to find out what the extra skill is that I teased at the top of the show. So I will hang here as best I can.
Come on.
So I do think it's going to go
higher.
Exactly. Hard to say the unemployment rate. Is it going to go 4%, 4.5%? I think in the near term, for those people that want to see the Fed dial back the monetary policy moves that they're making, and by that I mean slow the pace of increases down, get to that terminal rate sooner than later. I think the higher the unemployment rate goes more quickly, the more likely we will see that. So that's, we'll see.
Real quick on this before we go, the estimates I've seen in terms of how many more Americans may lose their jobs, I've seen ranges from 500,000 up to 2 million. Is my range off? Are you seeing or getting a sense? So we're at 3.7 now. If we go up to 4.5 or wherever the final, not to say terminal rate, to borrow another phrase, but wherever that final rate is that about the expectation? I mean, we're talking north of 500,000 people, perhaps, right?
Perhaps, and it's, so you're kind of getting into the math behind the unemployment rate. It's a little tricky because it isn't just the number of people that left jobs. You have to factor in the number of people that are leaving the labor force too. So it gets a little wonky, but I would say that somewhere within that range is probably closer than not.
Yeah, absolutely. And I just want to, as difficult as it is to pin that number down, I like to have that part of the conversation for a bit of context and perspective for people who say, oh, well, what is 3.7? Like, what does that mean? Where you got 330 million people in this country. Give me some sense on what we're talking about. Those are the estimates I've seen ranging from names like Goldman Sachs and others. So it's worth it to at least address, and I think you framed it appropriately there. Okay, my man, it's the top of the hour. Time now for our rapid fire section, the last one of the year. Okay, first up, as we head into 2023, my friend, what is one stock that you are eyeing?
So keeping with our aging the population theme, we know there's a continued nursing shortage out there. We've seen the shares of AMN Healthcare, which we own in the AAP portfolio, pull back. We're eyeing buying more. The data point, the catalyst that we're looking for will be next Wednesday's JOLTS report.
Okay, yes, something we talked about earlier. We will be eagerly following that along. Number two, what is one stock you might be rethinking? Really?
Yeah, so one of the names that we owned in the AAP portfolio, and I like longer term, given the fact that chips are essentially the new fabric in our digital lives, was Applied Materials. And kind of what I was looking to see is what's the timing for the CHIPS Act as America looks to reshore their chip capacity. I think that's a great thing from a competitive perspective, especially coming out of the pandemic when we learned a lot of hard lessons on that. However, given the downturn that we've seen and the recent CapEx cuts announced by Micron, I think we're likely to see more by Intel, by Taiwan Semiconductor as we get into January. That likely means there's more downside for semiconductor capital spending in 2023 than we previously thought. Need to see how that might balance out with the CHIPS Act. In other words, AMAT might be more of a 2024 story now than one for 2023.
Taiwan Semi, such an important name to follow. Third and finally, New Year's Eve plans. Party animal, or are you fast asleep a minute after midnight?
So the answer to that is really going to hinge on what happens tomorrow night. So let me tie this all together. Where was I last night? Costco. What was I doing? Believe it or not, I bought something like 200 chicken wings. Why would I be buying 200 chicken wings? Because we are having a bunch of people over and we will be doing the official Hot Ones Challenge. So depending on how many chicken wings I eat, how burned out my palate is, that will determine what my New Year's Eve plans are.
So you may be in bed by like 9:30.
I might be in bed all day. I might be in bed all day on the 30th. I don't know yet.
That's fair. I like that. I like that a lot. There's, Fish does a big annual New Year's Eve run here at Madison Square Garden, and I've never gone the night of New Year's Eve. This may be the year I have to buy a last-minute ticket and go see Fish that night. If not, it might be tomorrow night. But we also got great football games on New Year's Day, so I got to be careful.
But if you don't do that, do they still do that midnight run in Central Park?
Oh yeah. That's always a very popular thing, for sure. So we'll see. So either I'm at the Fish show or I'm exercising, I guess. It'll be one of the two. Regardless, this is our last show of the year, Chris. It was fantastic to do the show with you all week, and I can't wait to do it again with you. Send you the best for an amazing holiday season, and Happy New Year to you, my friend. Thanks for helping us get smarter.
I just try to do what I can. Thanks to you for making it easy, and to everyone watching, have a Happy New Year.
Absolutely, and enjoy the wings, and of course a special thanks to everyone who helps make this show possible, who you don't see on camera, who is responsible, all the producers, and Sean, Julian, Rebecca, Ross, everyone across the board. They have brought you this show all these many months. I am deeply in debt to them, and they have my gratitude. That's going to do it for our final market open here of 2022. We will be back here on the floor of the New York Stock Exchange on Tuesday, the 3rd of January. Stick with TheStreet for more on these and all of the major market stories that matter to you. Happy New Year, and we will see you in 2023.